Do you like sweet treats and the treat of sweet dividends? Then have we got the episode for you. Hey, what's poppin', y'all? My name's Russ. I am a passionate passive income investor, and I also happen to be a welder, sharing things that I'm doing here with you on YouTube. And hot doggity, do we got the episode for you. It's almost Valentine's Day, but no matter. We're going to use that as a good excuse to show you 3 dividend growth companies that are sweet and involved in chocolates that you may find or candy for Valentine's Day and the such and beyond. Hey, Seeking Alpha has a really sweet deal on a premium subscription, so click the affiliate link in the description below to check that out. And also, while you're rooting around down there, we have our link to dapperdividends.com where you can sign up for our free, fantabulous, and fun weekly newsletter where we share a quick thought and all the portfolio activity from the week that was. Now, this first business you're probably not that familiar with, but it is one that used to be called Corn Products International, and it is now known as Ingredion, ticker INGR, which produces and sells ingredients derived from corn and other starch-based materials used in processed foods, textiles, cosmetics, and biodegradable plastics. They also provide sweeteners for food and beverage products, and while Ingredion doesn't directly make chocolate bars, they do play a pivotal role in manufacturing chocolate products. Their ingredients, like starches, are used in chocolate production and can help with thickening, texture, and stability in chocolate fillings or coatings. So this Valentine's Day, when you're eating that sweet chocolatey treat, remember that you may be consuming an Ingredion product. Ingredion is blessed with a dividend safety score from simplysafedividends.com of 99, very safe, current yield of 2.85%. They've been growing that dividend for 12 years straight, 14% 20-year CAGR, and they last raised at 9.9% in August of 2023. And they're currently paying a total of $3.12 per share every year. Now, their dividend yield is about 3% below the 5-year average, and their forward PE of 11.4 is also below the 5-year average. Free cash flow payout ratio usually is in the high 20s to low and mid 30s, currently at 27%, may tick up a little bit next year. Plenty of cash, $11.20, more than enough to cover that annual dividend. Their sales growth is at about 3%, so it's come down just a touch. Slowly buying back shares, currently down to 67 million shares outstanding. The return on equity is pretty nice, usually around 19-20%, which is where they've been at the last 12 months. Return on invested capital, definitely looking nice. Some of their other margins, just okay, could be a little bit higher. Net debt, only 33%, so they don't have a ton of debt. And their interest coverage ratio, $8.49 of operating income to cover every $1 of interest on that debt. Morningstar gives Ingredion a 4-star rating, narrow economic moat, and a fair value estimate of about $120. And now we find ourselves on finviz.com. We're going to look at a little bit of the charting. So each one of these candles that you see right here represents 1 week's price action. So it looks like there was some support around $90, pretty good support, which is also close to that 200-month moving average. And it's shot up quite a bit from October 27th, but we're going down this week, and I think that we could see Ingredion test support right around $106 a share. And if it breaks that, probably going to see some more support around $103. And I love this number right here. The price to sales currently, if you're buying them, means you're paying 87 cents for every $1 of their sales and $9.63 for every $1 of their free cash flow. So some pretty nice numbers for Ingredion. We'd love to know in the comments below if you've heard of them or what you think. Now, many of you may not know the name Mondelez, but I'm pretty sure that you know some of their brands like Oreo, Ritz, Toblerone, Chips Ahoy, Swedish Fish, and my favorite, Sour Patch Kids. Not too many of the Sour Patch Kids. They are really bad for your teeth. So in 2012, Kraft Foods separated their global snacking business, which became Mondelez, ticker MDLZ, and they get a dividend safety score of 66, safe, 10-year dividend growth streak. That makes them something called the dividend achiever. 10% latest increase in July of 2023, a 5% 20-year CAGR. So they've pretty much been raising that dividend every year since their spin out. Mondelez is currently paying you $1.70 per share every year. Their dividend yield, about 2.25%, is about 3% above the 5-year average. Their PE is about smack dab in line with that 5-year average of 21.1. Their free cash flow payout ratio, 61% the last 12 months. I like it. That's still pretty low. I'm comfortable with that. Their sales growth, look at that. It's been climbing ever since the pandemic year of 2020. Currently at 14% sales growth. Shares outstanding down to 1.37 billion. So they slowly buy back their shares. And look at this bucket of yuck with their total sales. Completely flat from 2016 to almost 2020. Not a whole lot of sales growth going on, but it looks like they've righted the ship up to $36 billion in total sales. Return on equity, not terrible, not great, just okay. Their margins, a little bit better. 17% operating margin, 10% free cash flow margin. So currently 10 cents of every dollar that they bring in is making its way down to free cash flow. And with that free cash flow, you can pay the dividend, you can buy back shares, you can carry it as cash on the balance sheet, or you can reinvest back into the business and do things such as mergers and acquisitions and what have you. Net debt also pretty low, only 39% of capital, and their interest coverage ratio, I like it, $11.06. Morningstar, which gives Mondelez a 3-star rating, wide economic moat, and a fair value estimate of about $73. Mondelez is just about fairly valued according to Morningstar. Now, as far as an entry point, check this out. It had been riding high at almost $80 a share and then took a bit of a tumble when all the CPG things started happening because of, your Wegovy and your Ozempic. Huge couple of down weeks, actually huge 4 down weeks, fell all the way to about $60 a share. But look at that. It closed the week and it bounced off of that 200-month moving average and it's just been up and away from there. Bit of a down week here. If I had to guess, if it continues to fall, looks to me like there's going to be some support around $72. I think it would find some support there, so probably going to see it go down to the low 70s. But we also want to know what your favorite candy is. Now, unless you were born, raised, and lived under a rock where they didn't have chocolate, I'm gonna guess you know who Hershey's is. Yes, Hershey's. They have your favorites like the Kisses, the Twizzlers, the Bark Thins, the whatchamacallits, the Reese's Kit Kat. We're not gonna read all of them. You get the picture. They do candy and they got a lot of chocolate candy. And at the end of 2017, they wanted to get into the salty snacking side of things. They bought Amplify brands and that gave them exposure to Skinny Pop, Pirate Booty, and Packies. Now, actually, as of this recording, they had their earnings. The damn thing shot up like a rocket. Yours truly made the egregious mistake of putting in a buy order because it looked like it was going to open up down at $188, went to about $188.72, and then just rocket shipped up. Their CEO, Michelle Buck, says things could be a little tight in the future because of the inflated cocoa prices, but either way, they increased their dividend 15%, and Simply Safe gives them a dividend safety score of 93, very safe. 10% 20-year CAGR for Hershey's, and there's that 15% raise that happened today. Dude, they've been paying dividends uninterrupted since the 1930s and have a 13-year dividend growth streak. Hershey's is hitting you with $5.48 of sweet dividends per share every year. And again, because things have been hit from people worrying about all the weight loss drugs, dude, don't bet against the American eater. You can't do that. Their dividend yield is 34%. Above the 5-year average of 2.03, so pretty high right now. And look at that forward PE, paying $20.40 for every $1 of their earnings. Love Hershey's, such a strong company. 54% free cash flow payout ratio, so they usually keep it pretty low. We'll sometimes see weird aberrations like that shoot up to 96, so they somewhat comfortably can cover that dividend at $7.93 of free cash flow per share. Sales growth had been climbing. Look at that, 16%. Huge sales growth in 2022. They very slowly buy back shares. For the last little while, they've been buying back about 1 million shares a year. Total sales finally starting to climb up. I love their margins. So solid. Return return on equity out of this world, return on invested capital. Does it get any sweeter than that? 27% the last 12 months. Really good operating margin, free cash flow margin, 15%. Dude, check that out. 15 cents the last 12 months of every dollar is making its way into free cash flow. Love to see that. That debt, check it out. It was at 78% 2016. It's all the way down to 55%. So they've been paying down that debt, and their interest coverage has been going up as they do that, currently at $16.42. Now, Hershey, a lot bloodier than Mondelez was when they hit that high of about almost $280 a share on May 5th. And then just like a stone, they fell all the way down to about $180, and they did what we call a double bottom here. When you see it looks like a W, that usually means that it's a reversal over the course of a while. Remember, these are weekly candles. Every one of these is a week, and it looks like we're probably got upward momentum here, and Hershey's is going to keep going. Might find some resistance right here at about $223, $225, which is at the 50-month moving average. Morningstar gives Hershey's a 3-star rating, a wide economic moat, and a fair value of about $197. And the thing I especially love about Hershey's is Warren Buffett talks about Coca-Cola and their mind share, meaning that people have really good memories associated with Coca-Cola. I think the same can be said for Hershey's, that people have really special memories tied to the Hershey's brand, which is just one more feather in their chocolatey cap. Now, if you like dividends and you like rock stars, I have a special treat for you. I had a very cool conversation in this floating little box next to my head with our friend of the channel, Jonah Weingarten, who, yes, is a rock star. Check the video out to see what we're talking about there. And if you do that, Jonah and I will talk to you there.